Welcome back, guys, to another roundtable. So my name is Adam. Right next to me is Victor.
Hi, everyone.
Rusmin.
Hi, everyone.
And Kenny.
Hello.
So welcome back, guys. Happy Lunar New Year. 恭喜发财.
红包拿来.
All right. So thank you for joining us on this roundtable once again. So, I mean, since it's on the topic of, Lunar New Year and, we receive ang paos,
Yes.
right?
Yeah.
Every year. If
No,
you're,
this year I have to give ang bao.
you're married.
Oh, yeah.
So we're all married except for Kenny. So
Yeah.
Kenny's still
So
receiving
this year,
ang paos.
the flow not very good. Must be COVID-19.
Yeah, but on the topic of ang paos, it's kind of like receiving
Passive
dividends,
income.
passive income,
Yeah.
right, in a way. So in this roundtable, we're going to talk about dividend investing and what our the favorite markets we have for investing for dividends. All right, so we're going to discuss that in this roundtable. So, but before we dive into dividend investing, I think one question a lot of people may want to ask is whether dividend investing is still relevant today, because over the last 3 to 5 years, growth stocks have really come to the fore. Right,
Yeah.
we have FANG,
Tesla.
Tesla, Zoom, and all these stocks that have just grown tremendously over the last few years. And a lot of times when you go on social media, it's kind of like everyone's talking about the FANGs and everything.
Yeah.
So is dividend investing still relevant in today's market?
Well, I
What do you
think
guys think?
I think the truth is that dividend investing never out of trend, right?
Okay.
So that is something that people who do income investing generally they will still get their passive income regularly, right? Whether it is on trend or out of trend, they will still receive their passive income, because most income investors generally, when they invest for income stock, they will structure their portfolio in a way that this group of companies that the investor will consistently give them a passive income every quarterly, all right, and the more they invest, the more money they actually receive. So it doesn't matter who the market actually invests in, Tesla or FANG, this group of people who quietly behind the scene, they are receiving their passive income, right? So I don't think you'll be out of trend. It's still very relevant in today's context, especially if you're looking to build passive income.
Yeah, and of course, I also think that dividend investing is good for two groups of people. First is the beginners. So for beginners, generally they cannot take volatility in the market, and usually these companies are mature. So even if you make a mistake here and there, you turn out all right over a long periods of time. And of course, at the same time, if you're old and you're not active, then of course that's when the passive income kicks in, right? So you want to grow your growth portfolio for let's say 20 years, roll it like 15% compounded annual returns, and until you're 50 or 60 when you retire, you're going to switch out and get to a dividend vehicle that pays you about 5-6% a year, and then you can retire comfortably with that income basically.
Yeah.
So I think growth stocks also come with risks, because they tend to grow very fast and the valuations are very, very high. So I think the advantage of looking dividend is still in trend is because when your stocks are still not doing that well, you are still collecting your dividends, right? So overall, even though if your share price decrease, you still make money because you get a dividend. But for growth stocks, if you invest, there's no dividends. When the share price decreases, you're already making losses on that if you realize on the portfolio, right?
So I think it's like when it comes to growth stocks, there's a lot more work involved.
Yep.
You need to do more research. You need to really understand and try to predict the future. What stock is going to be the next big thing. But when it comes to dividends, it's a bit more, steady, stable. You kind of know which companies are big and paying the consistent dividends every single year.
So the approach is always very simple, right? You look for those companies that are relatively stable or matured, and these companies usually they don't change that much. So a good group of stocks that you can look at, of course, is REITs, real estate investment trusts. Okay, so this is a kind of trust where they don't really change that much over time. I mean, property is something that we all rent or sometimes buy to lease it out, collect rental income, right? So it's very, very stable. You don't really need to look out for the next trend that's going to come in, in order for you to make a big bucks off it. But for dividend investing, I mean, you just sit down there, collect your passive income.
So, Rusmin, what's the advantage of investing in REITs over like owning properties outright? Because we Asians, we love to own properties, right?
So when it comes to invest in income stocks versus investing in the physical property, and generally you don't have to come out a lot of capital. So anyone with a few $1,000s can start off with investing into a REITs, for example, and that gives you an easy yield of around 5%. That you can actually get it. Versus residential market today, we go out there, whether in Singapore or Malaysia, I think you can only probably get a net rental yield of about 3%.
Yeah.
So it's actually the valuation is high.
And you pay tax on your rental income.
On your rental
on your
income,
property
yeah.
rental income
Yeah.
as well.
So
you-
actually, the best place to look at REITs is actually Singapore.
Yeah.
That's
Yeah.
one of the biggest REITs market also.
So I think that's the thing we want to cover next, because when it comes to dividends, there are certain markets that actually are more suitable for dividends.
Yeah.
So we want to talk about the favorite markets that we invest in for dividends. So we're going to cover a few of them. Let's start with the first one. What about Singapore? Is it the best? I mean, is it a good place to invest for dividends?
Well, I think Singapore is definitely a good place to invest for income because there are a lot of mature company listed over here. You don't really have a lot of tech stock in Singapore, and you can generally look at for those companies that are a lot more regulated, like banks. Bank is a sector where I think they've been paying a very stable dividends until COVID came, where the MAS actually had to step in to tell them to cut back on the payout ratio, basically to conserve the capital for the crisis, right? But so far, I think once COVID is over, I think we can expect that the bank will start to resume the dividends again. Yeah.
I think with interest rate going up, I think they are still in a very favorable condition to moving forward.
So there's just one group of companies or income stock you can look at, and the other one the REITs. And of course, there are certain sectors like companies that are also in the property development companies, but they own a lot of the assets in terms of investment property. This group of companies also collect very stable rental income. You can also look at those companies as well, right? And of course, we still have like F&B, some of F&B companies like Sheng Siong, right? So far they've done really well during the COVID-19. Yeah.
And all your gains and dividends are all tax-free.
Yeah, dividends are tax-free
in Singapore.
So every single cent you receive, it's yours.
Yep.
Yes.
You don't give anything out.
Yeah.
So I think it's very conducive. I think it's very attractive for people who just want to invest in dividends. But what about the growth in Singapore? I think Singapore has this reputation for you don't really have the most exciting stock market. So does it affect your dividends if you invest in Singapore?
In terms of growth, I think it's relatively limited. But for those people who invest in income, they don't really look for a lot for growth. I mean, growth is always good to have, right? And if you have growth, you're likely going to have more capital gain and dividend growing along year after year. But Singapore, the setback is that we don't really have a lot of companies that are in the high growth sector, right? So which is fine because those usually don't pay dividends, right? And the other thing with Singapore is that it's very dependent on the world economy. If the world economy is not doing well, then you may have see some of the companies cut back on dividends. I think COVID is one of the big examples where a lot of companies were actually affected and they have to cut back and pull back dividends. And one big sector is going to be the retail REITs. Generally, in the past, I think we usually have seen, retail sector have been quite resilient. But COVID this time around changes everything, right? Because government again step in and tell the retail landlords to give rental rebates to the tenants.
But it seems like a temporary issue because we still have high quality assets. Singapore is a place where I think all of us have to go to the mall. I don't know where else you can go. So you want to go there. So I think over the long term, COVID sucks, but over the long term, these REITs should still do well. Your dividends will still grow over time, right?
They will definitely do well.
So again, COVID is just temporary. So if this is really a time where the price is still depressed, in fact, this is a really good time for you to actually look at those companies, which is what we did at the time.
And Singapore, even though it's not high growth, there's still growth. And your dividends, if you pick the right quality stocks and REITs, your dividend growth is there as well, right?
I think generally you're looking for those. Most companies here probably can grow at maybe single digit, that kind of range. You don't really see a lot of companies here growing at double digit, which is fine, right?
Because your dividend yield are much higher.
Yes. So you're compensated in the form of higher dividend yield.
So Singapore seems like a really good place for dividends, stable, predictable, a lot of mature companies.
Valuations are reasonable.
I think that's true.
Still cheap Singapore market.
So when it comes to dividends, your valuations play a big role as well because you want to get a higher yield as well. So let's move on to another market. So besides Singapore, what would you look at?
Hong Kong, right? Hong Kong has a lot of similarities compared to Singapore, right? It's tax-free in terms of capital gain and tax, dividends. And also the dividend tax-free as well. And they also have a lot of property sectors. They have banking sectors. Basically, it's a financial hub, very similar to Singapore. Right, and over there, of course, you have more access to the Chinese market. So the growth there, as compared to Singapore, I think is a lot better.
Okay. So any examples of a Hong Kong stock that's dividends, but it's going to benefit from the growth in China and all that?
Soya milk company, Vitasoy.
Okay, Vitasoy. Okay, I haven't had that for a long time.
It used to be a dividend company without growth. until they
Yeah.
not without growth, but with growth, but slow growth, but they broke through the China market,
Yeah.
and their share prices boom.
So there's a growth story now because now
Yeah.
they've like entered
Yeah.
the Chinese market.
Correct, but of course their dividends also going upwards also.
Yeah,
Okay,
and you
that's
have property companies that have asset in China, which is actually growing really fast. Yeah, so those the luxury retail market is actually growing really fast over there. Yeah, so certain companies like Hang Lang, right, those are the companies that are very good position to grow their dividends over the next few years. Yeah,
And the currency is pretty stable as well.
Yeah, correct.
Yeah.
When it comes to dividends, you want to make sure that you receive something that's
yeah. So
that
most of the
hold its value.
Hong Kong listed stocks are actually in Hong Kong dollars.
Yeah.
So Hong Kong is pegged to US dollar. So long as US dollar continue to be stable, I think we can
It should be. I mean, it's a
Yeah.
reserve
Yeah.
currency. Shouldn't change for some
Yeah.
time.
Yeah.
So I think that still works in Hong Kong's favor.
Yeah.
Yep.
So okay, what about another market? What would you look at?
I think for our audience here, I mean, we have also some Malaysian audience. Malaysian market is also a pretty attractive market to look at because it's also tax-free for capital gain and dividend tax, except for the REITs. I mean, they do charge 10% withholding tax over there. Yeah, but other than that, I think for Malaysian who are looking to invest in income stock, I mean, they can generally stick to the local market because they don't have to, accept the currency risk. Yeah.
That means the companies that just run their business in the domestic market only.
Yeah, but
Yeah,
for people like us, if you're a foreign investor, I think
If you were to, let's say if you're a Singaporean or US, you want to go to Malaysia market, you don't want to invest in their domestic market. Because if you look at the ringgit in the past few years, they have always been depreciating, right? And I think it is it's a good thing for them to keep depreciating is because they are in the export market, right? To keep their currency low so that they can stay competitive. So if you are a foreign investor, you want to look into Malaysian market, you should invest in their export business because they export in US currency. So the moment the ringgit depreciate, you can see that they perform very, very well. And all these export companies in Malaysia, right? They are not only in Malaysia, but they are also like around the world. Like let's say the glove companies, like your Top Glove, your Hatta Lega, and they also give increasing dividends also.
Yeah, and
right?
some
So they
of the
are,
semicons players, FMCG players like Nestle,
Yeah.
Large Lady. I mean, those are the companies that have been paying very solid dividends
Yeah.
for the last 10 years.
Yeah, but
20 years.
Nestle and Dutch Lady, I think it's better for the existing Malaysian
Yeah.
to look at.
Because they have more of like a domestic
Yeah, they
consumption.
are domestic consumption. only.
Consumption.
So what you're saying is when it comes to Malaysia, because of the risk of the ringgit depreciation,
Yeah.
you want to invest in a stock that exports globally.
Yes, correct.
Because then,
If you are a foreign investor,
if you're a foreign investor, I mean,
Yeah.
for Malaysians, it doesn't really matter because
doesn't really
the
matter,
ringgit
yeah.
is still your ringgit.
yeah,
Yeah.
Yeah, but if you were going to look at that, you want to invest in a business that has a global, export business,
that's correct.
and that will benefit the company, and that will
Yeah.
raise the dividends.
Yeah.
Yeah. Top Glove is one
Yeah.
good example where
So
they
even
export
then,
it.
even then, if you kind of like lose out a little bit on the
Yeah.
forex, it kind of makes up for it
Yeah.
because the
Yeah.
growth is there.
Yeah,
Yeah.
because like I say, the Malaysia they depreciate against the, let's say example, I invest from Singapore, they depreciate against the Sing dollar, so it's not stable. But in the Hong Kong case, it's different because Hong Kong case has always been quite stable against the Sing dollar. So that's why Hong Kong there's not much of a risk if you even invest in their domestic business.
Yeah.
But then Malaysia does have some
Yes.
like really good manufacturing businesses with export.
Yes, correct.
That have the world as their market, which
Yep.
is pretty different from Singapore and Hong Kong.
Yeah.
Correct.
All right. So what about the US? I think the US is going to be the main market for many people.
Yes, definitely.
Yeah. So what about the US for dividends? What do you think?
US for dividends is actually quite interesting because, like you mentioned, you want a company that export maybe cater to the global market, right? Then US, you can find many of those companies, and there's this one index that S&P 500 created, which is called the S&P 500 Aristocrats. So they have a total about 66 companies within that index. And one of the downsides of investing in US companies is that you have to pay a 30% tax on your dividends. Yeah. But then again, these are companies that we are all very familiar with: 3M, Clorox, Procter & Gamble, Coca-Cola. And every year the dividends will increase year over year. But the difference is that in Asia, usually the dividend percentage is much higher, right? 5 to 6%. And then in total, the total return will be about 8 to 10%. But when it comes to the US, because the dividend is around 2.9% for the past 10 years, total return is about 13.5%. So the reason why it's so much higher is because they reinvest most of their profits back into the business, and at the same time they buy back shares over the years. So if you're looking for more capital appreciation rather than dividends, then US market is probably the place for you to go.
So what you're saying is that even for dividend aristocrats, so dividend aristocrats are stocks that have increased their dividends every single year for 25 years.
Yes, that's right.
So that's a tremendous track record.
Yeah.
But even for dividend aristocrats, the yield is about 2 to 3%, 3%.
3%, yeah.
About
Okay, you say
3%.
3%.
And there's a withholding tax on top of that if you're a foreign investor.
Yeah.
So it comes about 2%.
yeah.
But then it makes up for it through the capital gain that they have.
Yeah.
Yeah.
So in that sense, for dividends, the US doesn't really make sense if you're a foreign investor
Yep.
Yeah.
because the yield is lower, valuations are higher, and everything's they kind of do the share buybacks to kind of generate growth in their stock price and all that.
Yep.
Yeah.
So it's kind of skewed towards capital gains rather than
Correct.
dividends.
Yeah.
So that's
Yeah.
what's the US.
So, but if you're the US citizens, then you're going to tax on your capital gain.
Okay.
Right? So that is even.
I mean, as
worse.
a US citizen, you have taxes
Yeah.
almost everywhere.
Yeah.
But then it kind of seems like the US, even though they have some really great companies like Coca-Cola, super stable, super global presence and everything, pay very, like they said, 25 years of increasing dividends.
Yeah.
It still doesn't really kind of make sense to go to the US market for dividends,
Dividend.
right?
Yeah,
It's kind of
that's
like,
right.
It just makes more sense to go for growth or capital gains over there.
Yep.
Yeah.
All right, so
That's why I don't really invest. If I were to choose dividends, probably not the US for me, like for Singaporeans.
I think a lot of people here in Singapore actually do that. They kind of have like a two-pronged strategy where
Yeah.
they have dividends in the Singapore, maybe some Hong Kong, and they collect dividends on that. And then they have a growth engine in the portfolio as well, and they look at the US stocks
Yeah.
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 that really
That's a
have
good
the
strategy.
potential to
Yeah.
maybe double 10 times in the next, I don't know how many
It
years.
also depends on your age.
On your age
Yeah,
as
yeah.
well. So I think goes back to the first question where it's not an either or thing where do you invest in dividends or do you invest in growth? It's kind of they can do both.
Yeah.
It really
Yeah.
depends on the proportion that you want in your portfolio. Some
Yeah.
people are just more risk averse. They want more dividends, 50% of their portfolio, 80%, whatever it is.
Yeah.
Some people are just more, adventurous,
Yep.
and then they may go 80% growth. And
Yeah.
then as they get older, then they become more boring, and then put more in dividends and everything. You don't want to lose my money and all that, right?
Yeah, but for when it comes to choosing income stock to invest, generally of course it's not that straightforward, right?
Yeah.
Yeah.
That's right.
Because Asian, I mean, you have a lot of in the past we have a lot of S-chip that turned out to be a fraud company. They pay dividends.
S-Chip are China's listed company in
Yeah.
Singapore. Yeah.
So you just need to have again a system where you can actually go and look out for those companies can give you very stable dividends in years to come, right? So you need to have an approach, right? And basically you need to know how to find those income stock. And I think currently we are actually launching this dividend machines where we're actually going to teach you how to find those dividend stock step by step basis. And also on top of that we have I think bank modules as well as the REITs, real estate investment trust, and we were going to give you a system on how to pick the best REIT because Singapore have about 40 REITs and not all of them are actually a good REIT. So you need to really properly go and assess which one is the good REITs to invest for a long run.
So we're saying not every REIT, not every dividend stock is created equal.
Equal,
Doesn't
yeah.
mean that Singapore is a great market for dividends.
Yeah.
You just pick any dividend stock. You
Yeah.
still have to pick the right one.
Yeah.
Right?
So a lot of beginners tends to look out for those REITs that have higher yield.
Yeah.
And then they ended up losing money from there.
And there's a
And
reason
that's-
why the yield is so high because no one wants
Yes.
it, right?
Yeah, so I look at the case of First REITs, Eagle Hospitality. Those are the REITs that tends in the past was trading at a very high yield. And people were just naturally attracted to it without understanding the context. These companies actually, or these REITs actually have a lot higher risk. Yeah, so you need to know how to assess them before you actually invest in them.
So you have to learn how to differentiate between high risk and opportunity, right?
Yeah.
A safe opportunity, right?
Yeah.
All right.
Yeah.
So where can they check out this course?
Dividendmachines.com.
Dividendmachines.com. So if you're interested to learn how to invest in dividend stocks and REITs that are high quality
Yeah.
and they pay a growing dividend almost every single year, you look for dividend growth as well.
Yeah.
You can go check out dividendmachines.com. I think we have a course for you, a video course and live webinars as well if you want to learn all those things. And Rusmin and Victor will be your trainers for that course if you're interested. So it's only open until the 14th of March this year. So do check it out if you're interested. So going back to the discussion, we've covered 4 markets: Singapore, Malaysia, Hong Kong, and the US. So if you want to invest in dividends, which market would you invest in? What's your favorite? What's your style?
Singapore and Hong Kong.
Singapore, Hong Kong.
Tax-free.
Tax-free, yeah. Okay.
And a lot of companies pay very attractive yield. I think you can in the market can find 5% easily or above, right? Yeah.
Yeah, I
So
think
those-
it's
Yeah.
quite simple to get 5% yield from the get-go.
It's quite easy for
Yeah.
current market.
In the current market.
situation,
Yeah. And
I-
pretty
if
good.
with US at the all-time high valuation, I mean, Asian
Yeah.
markets are still cheap at this moment, right?
So you go for Singapore and Hong Kong
Sure,
as well.
definitely
Yeah,
Singapore. and
US
Hong Kong,
is
yeah.
for growth.
Yeah.
For growth. Then would that be the same for you as well, Kenny?
Yeah, I would say like for most people, it's best to stay within the country that they invest in the country which they are in, right?
Yeah.
And because you don't want to get exposed to the forex and stuff. For me, I prefer to stick with REITs and banks. So yeah, it's really straightforward and I understand. And since most of the time I'm doing like growth investing, so then I would like to have more yield if I invest in growth.
So you have one
in
portfolio
dividends.
for growth, another one for dividends in Singapore.
Yeah, if I choose to.
If you choose to do that, yeah.
Yeah.
So that's the way you would optimize it if you want to do it that way.
Yeah, that's right.
Yeah, right. So I think that's what a lot of people have. I think based on these discussions that we have with our students and all that, they more or less say the same thing.
Yeah.
All right. So I think that's a pretty good wrap up. So I think thank you guys. If you're thank you for joining this discussion. If you really like this video and you learned something about this discussion today, feel free to hit the like button, subscribe to our channel as well, and of course, do check out dividendmachines.com if you're really interested to learn how to invest for dividends. It's a different way of investing from growth companies, and you're focusing on how you can maximize your dividend income for many years to come. So go to dividendmachines.com if you want to find out more about that. All right. So thank you again, once again,
Thank you.
guys, for joining us.
you.
Thank you. We'll see you around, and thank you so much for joining us.